All right, we're about to dive deep into a force that's quietly reshaping our entire global economy. We're talking about a potential sovereign debt crisis that is, well, gathering steam right under our noses. Let's just start with this. Think back to 2008. This quote perfectly captures the absolute shock that just rippled across the world. It was a moment that completely redefined how we think about financial risk, and honestly, it's the perfect place for us to start if we want to understand the danger we might be facing today. To really get a grip on what might be coming, we have to rewind the clock. The last major crisis holds some pretty serious lessons for us about just how fast things can completely fall apart. I mean, the speed of the collapse was just staggering. This wasn't some slow burn. It was a firestorm. The bankruptcy of Lehman Brothers, that was the spark. And within days, that one single event set off this catastrophic domino effect that froze the entire global financial system. We're not talking about markets dipping. They absolutely plummeted. And the consequences for regular people, well, they were devastating. It was a brutal, brutal lesson in how interconnected and really how fragile our system had become. After 2008, the entire world focused on fixing the banks. But while all eyes were on the private sector, a totally different kind of risk was growing, almost silently, in the public sector. The very institutions that bailed out the system last time are now becoming the source of the next potential threat. And that right there brings us to the big question we need to try and answer. With government debt at levels we've never seen before all around the world, are we just sort of sleepwalking into a completely new kind of crisis? To answer that, we really have to understand how we got here in the first place. And it's a story that's unfolded over decades, really, all fueled by this powerful and, well, ultimately deceptive economic condition, the era of cheap money.
Just take a second and look at this number. $300 trillion. That's the total amount of global debt, from governments, from corporations, from households, all of it. It's a number so huge it's almost hard to comprehend. It's more than 3 times the size of the entire global economy. And the most worrying part of this giant pile of debt, it's the part owned by governments.
So how did this happen? Well, this timeline really shows the 2 key moments that just supercharged government borrowing. First, in 2008, governments had to step in and basically become the lender of last resort. They spent trillions to stop the banking system from completely collapsing. Then, just as the world was kind of getting back on its feet, bam, the COVID-19 pandemic hits. And this forced governments to unleash the biggest stimulus packages in history just to keep their economies from grinding to a halt. In both cases, the message was pretty clear. When a big crisis hits, the government is the only player big enough to save the day. Now, for years and years, this explosion of debt didn't really seem to matter all that much. And the reason why is right here on the screen. Cheap money. For more than a decade, the world's major central banks kept interest rates at or near zero. This made it incredibly easy for governments to borrow huge amounts of money without worrying about crushing interest payments. It created this dangerous illusion that it was all perfectly safe.
But that illusion, that party, it couldn't last forever. An old economic ghost, one that had been asleep for decades, came roaring back to life, and it completely changed the rules of the game.
This slide just lays it out perfectly, the dramatic shift we've all lived through. On the left, that's the world we all got used to, right? Low interest rates, where borrowing felt almost free. And on the right, well, that's our new reality. The post-pandemic supply chain chaos combined with all that stimulus spending. It ignited this firestorm of inflation. To fight it, central banks had no choice but to slam on the brakes by jacking up interest rates. And they did it with a speed we haven't seen in a generation. All of a sudden, that mountain of debt that seemed so manageable was no longer a small problem. Okay, let's make this tangible, because these numbers can get a little abstract. Imagine a country with a national debt of $2 trillion. That's a very realistic number for a major economy today.
Now, what happens when the central bank raises its interest rate by just 1%? It sounds so small, doesn't it? But the ripple effects are absolutely enormous.
That tiny 1% hike, it means an extra $20 billion in interest payments every single year. That's $20 billion that can't be spent on healthcare or infrastructure or education. And now, multiply that effect across dozens of countries with the interest rates rising by several percentage points, and you start to see the terrifying scale of this problem.
So this new world of expensive money doesn't just raise the costs. It actually creates the perfect conditions for this self-reinforcing cycle, a feedback loop that can destabilize entire nations.
And look, there's this dangerous idea out there that debt crises are only a problem for small, developing countries. That could not be more wrong. Japan's debt is more than double the size of its entire economy. The United States has the largest national debt in the history of the world, and we all saw what happened in Greece, a modern European nation pushed right to the brink. It was a stark reminder that in our interconnected world, absolutely no one is immune. So let's break down exactly how this happens. It's really a psychological game that gets played out in the global bond market. See, it all starts with confidence. When the investors who lend money to governments, the people buying their bonds, start to get nervous, they demand a higher return for the risk they're taking. This forces the government to pay higher and higher interest rates, which means a bigger and bigger chunk of their budget goes to just paying off the interest on their debt. That leaves less money for everything else, which of course makes investors even more nervous. See the cycle? It's this vicious feedback loop, a debt spiral, that once it really gets going is incredibly hard to stop. And this isn't happening in a bubble. Governments are being pulled in a dozen different directions at once. Geopolitical tensions are forcing them to spend more on defense. The transition to green energy is going to cost trillions. The race to dominate in artificial intelligence requires massive public investment. All of these things are critical, but they all require one thing: more borrowing. And it's happening at the exact moment that borrowing is becoming more and more dangerous. So what's the bottom line? What are the real-world implications if one or more major economies just can't handle their debt anymore? What does it actually look and feel like for us when the system finally breaks? The consequences, they're not abstract. They are deeply personal. We're talking about chaos in financial markets that could wipe out a huge chunk of your retirement savings practically overnight. We're talking about the money in your pocket losing value, making everything you buy more expensive. To get their finances in order, governments would be forced into making painful choices, what we call austerity, slashing public services and raising your taxes. That 1-2 punch would almost certainly shove the economy into a deep recession, which means slower growth and, yes, widespread job losses. But here is a really critical point, and it's one that often gets overlooked. These moments of crisis, as destructive as they are, they're also moments of profound transformation. They don't just create losers, they also create winners. Old industries might collapse, but new ones, better suited to the new reality, will rise up to take their place. Wealth gets transferred, power shifts, and the people who understand the big macroeconomic forces at play, they can not only navigate the storm, but potentially even benefit from it. This quote just captures the moment perfectly. The global economy is truly at a crossroads. You've got this combination of record debt, the end of cheap money, rising geopolitical instability. It's all created a system that is far more fragile than most people realize. The red flags aren't on the horizon anymore. They're right in front of our faces. So all of this leaves us with one final, and I think really essential question. In an environment this complex, this uncertain, where the traditional safe investments might not be so safe anymore, what is the single most important thing you can have? The answer isn't a stock or gold or any other asset. It's knowledge. In a world this complex, the ability to understand these powerful forces that are shaping our future is no longer just some academic exercise. It is becoming the most essential tool for financial survival and for building real, lasting wealth in what is shaping up to be a very turbulent decade to come.